Hello there, I'm Michael Stapleton, the owner of ProVeritate, a virtual CFO practice based in Melbourne. A couple of weeks ago I posted a video about the importance of business owners paying attention to their balance sheet. Now the reason I posted that video is because the number one reason why profitable businesses never seem to have any cash is because that cash is being hidden away in the balance sheet. So today's video is a primer, and it's designed to help a business owner use and analyze their balance sheet to work out where they've hidden their cash. So let's get down to it, shall we? Rule number one, when you're analyzing your balance sheet, use two balance sheets. So the idea behind this, the process, is when you're using two balance sheets, you are going to compare the movement in the accounts from the earliest balance sheet to the most recent balance sheet. That movement in accounts will tell you whether cash is moving in or moving out of the balance sheet and in or out of your business. Before we go on, a very quick note on the structure of a balance sheet. So your typical balance sheet looks something like this. The first section is for assets. You'll find accounts like cash, debtors, inventory, and fixed assets in it. The next section is liabilities. You'll find accounts like creditors, loan accounts, and your statutory obligations. And the final account is the equity, or the final section of the balance sheet is the equity section. And in this, you'll find accounts like issued capital and retained earnings. Now, a balance sheet is structured in that manner because it follows the classic accounting equation. Assets minus liabilities equals equity. Right, let's get back to the rules. Rule 2, when assets go up, it's the equivalent to cash going out of the business. Imagine you've bought a car. So you look at your earliest balance sheet and your most recent balance sheet, and what you will see is the balance of your motor vehicle account in the most recent balance sheet is higher than the balance of the earliest balance sheet. To buy the car, for that balance to have gone up, you've had to pay cash. Cash has left your business in order for you to buy a motor vehicle. Rule 3, when assets go down, it's the equivalent to cash coming in to the balance sheet. So if you imagine that you're a shopkeeper and you have a storefront and people walk into your store every day and they grab things off the shelf and they come up and they buy that product for cash. What's actually happening in the background is the balance of your inventory account in your balance sheet is moving down, and as it moves down, the cash is coming into the business from the people that are buying that inventory. All right, liabilities. Rule 4, when liabilities go up, it's the equivalent to cash coming in. Let's go back to that example of the car. So we had a movement in our motor vehicle account balance. It's gone up from our earliest to our most recent balance sheet, and it's gone up because we've bought a car. Imagine as you look at the liability section of your balance sheet, you see that you've got a new account. It's a loan account. You've borrowed money from a finance company or a bank. So the loan account in your earliest balance sheet was 0, and now in your most recent balance sheet, there is a balance in it. The balance of that account has gone up. The liability account has gone up. It's equivalent to cash coming into your business in order for you to pay for that car. Rule 5, when liabilities go down, it's the equivalent to cash leaving the business. So when you pay your trade creditors, you pay them in cash. Your liability account trade creditors goes down, cash goes out. Rule 6, when equity goes up, it's the equivalent of cash coming into the business. Imagine you are bringing new shareholders into your business and you are issuing new shares, and they're buying those shares in order to buy their way into the business. As the issued capital account goes up, as the equity account goes up, cash is coming into the business. Rule 7, when equity goes down, it's the equivalent to cash leaving the business. So in this case, imagine you're paying yourself and your shareholders a dividend. Dividends are paid out of the retained earnings account. So when you look at the movement in your retained earnings account from the earliest to the most recent balance sheet, you notice that the retained earnings account has gone down. That is the same as cash leaving the business. Now, when you've done all that, you've looked at your assets, your liabilities, and your equity, and you've looked at the movement in each and every one of those accounts, you start to work out where money is coming from and where it's going to. And when you sum all those individual movements up and you arrive at a net figure, that net figure, if you've done it properly, will exactly match the movement in your bank account, in your cash at bank account, from that earliest balance sheet to the most recent balance sheet. I hope you found this useful. I hope this helps you find the cash that you might be hiding away in your business. If you have questions, and if you're not sure about anything I've said, please give me a call. My number is on the screen now. In the meantime, get out there, get looking at your balance sheets, happy hunting, and go and find that hidden cash.